Good morning, ladies and gentlemen, and welcome back to Boutiques on Wednesdays. Always great to see so many of you joining us, and thank you for your continued contribution. Today, we will have a look at SA fixed income that had a fantastic run the past 18 months. But with lower yields currently, what can investors expect? And should we be focusing more on risk management? We will also have a look at the application of portable alpha in an SA equity context. To cover this and more this morning, it's my pleasure to welcome Anthea Gardner, founder and managing director at Cartesian Capital, and chief executive officer and fund manager of Saffron Wealth, Brandon Quinn. Good morning, Anthea. Good morning, Brandon. Thank you for your time this morning. How are you doing?
Morning, Eugene. All good? Looking
Morning,
forward to
Eugene.
this presentation.
Yeah,
Yeah,
likewise.
fantastic. Even me, I mean, clients has a lot of questions. Is it the end of the party or is it still guns blazing? And I think both applies to SA Equity that also had a phenomenal run. But we'll unpack this and you'll give us guidance on that and what to look for, not to look for. To our audience, quick reminder, you know how it works by now. We're going to do both presentations. After presentations, take some questions, but you're more than welcome to post those questions in the Q&A bubble as we progress. Anthea, you're up first. You can start sharing if you are ready.
Thank you, Eugene. Hi, everybody. So, I am always tempted to retell the story of how I chose the name Cartesian Capital, but I'm not going to do it because I've done this before. You all know me, but I just want to remind you that the numbers you see on the top right-hand side of this slide are called Cartesian coordinates. And if you put those numbers into your navigation system, it'll bring you to the front door of our Joburg office. And if you, jumped ahead of myself. And if you put the numbers circled in the red circle, those will now take you to our new office in Cape Town. So that's a nice way of introducing that we have another office in Cape Town. We're there for you if you need us. So the last presentation I did in May of this year, this was the first slide, real yield opportunities in a volatile South African market. That was when Trump was elected as president. Things weren't that great between the US and South Africa. We were worried about the GNU and what was happening there, if they were going to stay together or fall apart. And in fact, we have had, and this is also one of the slides I put up last time, where to find real yield. And you'll see that the real yield, the difference, well, this time I've chosen repo, right? I could have chosen any interest rate. In fact, if I had chosen our money market fund, it would have been even better over inflation. It's the difference, or the real yield is the highest it's been in 20 years. That's a long time, and it's a great opportunity really for fund managers or financial advisors to give their clients low risk investments that outperform inflation. You don't have to add additional credit risk, you don't have to add duration, and still return proper income for your clients. So, of course, at Cartesian, we took full advantage of this opportunity. The Cartesian BCI Money Market Fund continues to outperform its benchmark. We also manage the Might and Optimal BCI Interest Plus Fund. Again, we're very happy with the way things are going. And as Eugene mentioned, the ALB, the All Bond Index, has had a fantastic run this year. It's up over 21%. So, of course, when I spoke in May, it was all systems go. Where do we go for yield? But I won't lie, I am feeling a little bit nervous, I think, of what is going on in the market. And so today I really want to talk about just how to avoid disaster, what we're expecting. I'm expecting some consolidation. Let me tell you that for free. And the South African government 10-year bond has fallen below 9% yield. There's definitely some cockroaches already beginning to show in some of the developed global economies, especially in my opinion, in the US. And in South Africa, I know there's a lot of positive. We've been taken off the grey list in record time, I think. We have a relatively stable government of national unity. Some economists are saying we'll be upgraded by S&P. And although the medium-term budget, which is coming up on the 12th next week, is really just a thermometer of where we are, I think the expectations are really positive. Economists are expecting debt to level off. The Reserve Bank's promoting this idea of low inflation target, which I think is good for South Africa. You know, I can't disagree with Kanyago. Inflation really is detrimental to the poor. And although this webinar audience, I suspect, is less concerned about that, the majority of South Africans live in poverty. And an 18% increase in meat prices really does hurt. You know, it hurts families and their budgets and their pockets. And also just kind of psychologically, it's an issue when you can't feed your family. So on balance of probabilities, on the balance of things, I think South Africa is on the right or positive trajectory. And the reality, though, and this is the nub of the situation, is that we don't operate in a bubble. And when cracks start showing in global economies, I'm expecting some sort of consolidation in our markets. So today I want to talk about risk mitigating strategies that we utilize in our funds to avoid disaster. And I'm sorry if I'm going to take you all back a step, but this, you know, we manage fixed income money. And you kind of have to understand the basics. And one of the things that really always gets people is the story of buy high, sell low to make a profit. I mean, have you ever heard about buying something at 110 Rand, selling it for 100 Rand and making a profit? Okay, I'm being cheeky, really, aren't I? Because really they're talking about yield. And in fixed income, just as a reminder, there are two parts, like two main parts to fixed income. There's yield and there's price. So really, my apologies if this presentation is a bit basic or contrived, but I think we're all a bit anxious about doing maths. In fact, even the maths people in my business sometimes are like, wait, hang on, let me just, I have to remind them to go back to the numbers. Because managing fixed income really is about maths and, of course, also a little bit about the macro. So just bear with me. There's no test after this, but I am going to fly through it because it's the basics before we get to the fun stuff. So let's just say I issue a bond. Let's say I'm a company and I issue a bond at 100 or par, as we call it, at a certain yield. And let's say that yields 10%. Let's say I'm the company. I want to borrow the money from you, the investor. I issue the bond. You lend me 100 Rand or you buy the bond. I'll pay you 10% per annum for this example. Once the bond has been issued, let's assume, for this example, that the issued yield doesn't change. But let's say that after the first year, you've received your 10 Rand in interest. Now you want your 100 Rand back, except here's the problem. I issued a 2-year bond. And I'm keeping this very simple. So, yeah, just so, and going through it quickly. So bear with me, sorry. And you're welcome to take out your calculators if you want. So now I've issued a 2-year bond. You've got your 10 Rand interest in the first year, but now you need your money because you've got another opportunity or commitment or something. So luckily for you, there's a secondary market in fixed income. So you go to the market because yields have moved lower. Isn't that great? The new buyer now only expects 9%, but you know that this bond is paying 10%. So you can sell the bond to the new buyer for 101 Rand. I'm like, can't hear anybody or see anybody, so I'm just going to assume you're all still with me here. You get your 101 Rand, and the new buyer buys the bond and next year gets his 10 Rand interest. It all works out because the expected second buyer only expects 9% yield. And if they bought a bond for 101 Rand, and they're getting 10% interest next year from me as the company, well, that's their 9% yield, right? And actually, even you've made 11% on your investment because of that extra 1 Rand and the price of the bond that you've bought. So yeah, you bought high, sold low, and made some money. So fixed income is really very cool. Okay, yeah. So I also know that it doesn't always go in our favor. So this is why I chose this topic as my presentation today. Some of the strategies we used in fixed income, not just buying high, selling, and hoping the market moves in our favor, but we use duration. So what I don't know how many of you are as old as me and remember the Nashua ad, time really is money? And the longer you issue bonds, the higher yield you're expecting. We use credit. We go up and down the credit risk curve. We use leverage, which I'm going to talk about a little bit later. And then we can decide whether we want a fixed or a floating rate note. So the initial example I gave you was a fixed rate. And we can also issue floating rates. So as the repo rate changes, the interest that I'm going to pay you as the company and you're the investor changes accordingly, but also, interest rates go down, not just up. So maybe that's when you want fixed. And then, this is probably illiquid underlyings is probably the same as credit risk. It's another risk that I want to get paid for, you as the investor, I should say, want to get paid for, as well as higher yield assets. And these are all great for generating above benchmark returns. But the problem with this is that all these strategies add risk. And so we have to manage that very carefully. And here are just a few examples of the risks that are easily identified in fixed income. I'm not going to explain each of them, but it's important to note that the most obvious risks are default risk, the risk that the issuer won't have the money to repay you the 100 Rand you loaned them, and mark-to-market risk. So I guess here is where I tell you about what has happened in the market in the last few months, actually. So credit spreads have narrowed. In other words, where before I could buy higher credit risk, so I could take more risk, and let's say I was getting paid 200 basis points over JIBAR, which is kind of where it was for the AT1s. I can now purchase the same bonds for only 37 basis points above JIBAR. In fact, that happened last week at the Nedbank auction, the AT1 auction. So the question is, to make up for the 63 basis points, I need to take on more credit risk or move up the duration curve or line. And basically all of that is so that I can get the same returns and taking more credit, but the same returns for you, the client. So I hope I'm beginning to paint a picture of my nervousness around the fixed income market, when I have to take more risk to get you the same return. So let's talk about what I'm going to do to make myself sleep better at night. So these two, as I mentioned earlier on, are your big fixed income risks. There's default. So this is the risk of the company or me not being able to pay you, the investor. And then there's mark-to-market risk. And we manage this through the default risk. We manage through fundamental research and less credit risk taking. I must tell you guys, I believe my first line of defense in managing risk is actually my team. And I have a very sharp credit analyst in my team who definitely knows balance sheets and cash flow by far better than I do, or I will ever hope to. So I use him. We make sure that the company we're buying bonds from, the issuer we call it, is creditworthy, will pay us our money at the end of the day. Mark-to-market risk is a bit more difficult. I can't control what the market is doing, but I can manage the risk. So the great thing about fixed income, let me remind you again, is that when you buy a bond and you know that you've managed your default, so you're going to get your money back at the end of the day, you know what your interest rate is, right? So shame my poor equity fund managers, that it's a little bit harder. The problem we have, though, is that in between you buying the bond at a certain yield and getting your money at the end of the day is this thing called mark to market. So the price of the bond moves. So in my first example, I issued a bond at 100, you sold it at 101. That can change. That does happen in the market, and that's called mark to market risk. And to manage that, basically, we're a little bit more technical. We use futures and options to make sure we can show in our fund that if the market does collapse, at least we've got some protection. So there's no real reason for us to take unnecessary risk in order to get the return that you as the clients want. And luckily for my clients, actually, my real big bugbear, if you like to call it that, is that I believe clients should not overpay for unnecessary risk taking. So to get you the return I want, I'm trying to utilize derivatives, futures, options, and my fundamental research in order to get you the same or a better than benchmark or a real return, which is harder to do, obviously. And then just very quickly, I'm not sure how much time I've got. I didn't check the time before I went into this. Sorry, Eugene. Some of the commonly used risk mitigating strategies is interest rate risk. So the great thing kind of, again, about fixed income funds is we have this plethora of tools to manage volatility, which I equate to risk. For me, volatility or risk is when a client wants to withdraw money from their fund or needs to withdraw money. Inevitably, the fund performance is down because the market has collapsed or something in that case. And especially in yielding funds where investors really use fixed income or yielding funds if they need a monthly income. So one of them that I really like is an interest rate swap, which is a financial contract where the two parties agree to exchange one set of interest rate cash flows for another, depending on what the notional is. And normally it's either fixed for floating or floating for fixed. Normally it's fixed for floating, where one party pays a fixed rate and the other pays a floating rate to hedge against the interest rate risk. That is one of our favorites, and in fact, we've used some swaps in some of our funds at the moment because it's a great hedge. We know we've built our core of fixed income assets, and we know what they're yielding, and so to protect ourselves, we can either buy puts or we can use these interest rate swaps. I think I don't have enough time to go into so many of these risk mitigating strategies. They do become a bit complicated, but just to let you know that the tools that we have in fixed income, and not only hedges, but also long only funds, is that we can do so much to protect getting a real rate or a rate return over your benchmark that you need. Just very quickly, just to wake everyone up, I want to talk a little bit about the mathematics of leverage. So a fixed income fund, let's say, okay, I'm going to give you this example. This is where you probably need your calculators. Fixed income fund has a NAV or net asset value of 500 million rand. The fund buys bonds averaging a return of 10% per annum. The fund also borrows an additional 1 billion rand at 5% interest and buys more bonds yielding an average of 10% per annum. Now, these are extreme examples, obviously, because I'm trying to make a point here. And long-only funds will use this to a measured approach, right? What do you think the return is if, let's assume the mark-to-market I spoke about, the change in the price of the bond stays the same? Let's assume, what do you think the return is in the fund after 1 year? Let me just walk you through it. Okay, so those are your options: 18.3, 10%, 14.3%, and 20%. If you buy bonds at 500 million and you get 10% interest in the first year, you're making 50 million rand. Then you buy bonds then you borrow money for 1 billion rand, and you're paying, because to borrow money, you need to pay, right? Unless you know somebody who can lend me money for free, let me know after this presentation, please. And let's say you're paying 5%, so you're paying away your 50 million. But then you buy bonds with that billion that you've borrowed, and you're getting your 10%, you're making 100 million rand return. And let's say you close out that position after 1 year. Don't forget, you've had your NAV of your fund, your initial money that you had was 500 million, and you've made 100 million on that fund, on that one position that you've traded for the 1 year. Very simplistic example, but again, just to make my point, your return with leverage for that example is 20%. Ordinarily, it would have been 10%. So basically, you've doubled your return. Now, here's the problem, the downside of leverage. The fixed income fund has a net asset value of 500. So the same example, right? Exactly the same example. But the problem now is that we have this mark to market that I was trying to explain to you earlier on. And the price of the bond has moved down by 20%. So instead of being able to get out of the bonds at 500 million, like you had initially, the bonds are now worth a lot less. And so when you are now 20% less. And so when you sell them now, obviously your mark to market return on the fund in 1 year is much lower. Okay, I'm going to stop there because I know you've all got calculators and you're going to work it out, right? So you've made your 50 million on your 500 million. Then you've had to sell the bonds for 20% less, for 400. So you've lost 100 million. And as much as we can make a lot of money from this leverage, I'm afraid the downside, if things move against you, if the mark to market moves against you, you easily lose. I'll let you know 10% is the answer on that one. I think I flew through that quite quickly, so I'm going to leave the slide up, and if you could please read the disclaimer carefully, there will be questions at the end. Okay, no, now I'm really just being mean. Thanks, Eugene.
Many thanks, Anthea. Very interesting indeed. I've got a couple of questions. Brandon, if you're ready, you can start sharing.
How's that?
Got it. Perfect. Thank you so much.
Excellent. Yeah, firstly, thank you, Anthea. You know, gearing is always a wonderful topic to discuss. I'm sure we can talk about gearing all day. Specifically, you know, how to because what's great about it is you're optimizing both a funding cost and a return expectation. So the two dimensions are very much you know, going to making a potentially great investment. And on that line of thinking, I'm going to introduce, if you guys haven't already been introduced to, the concept of portable alpha. So whilst it is not gearing per se, it very much utilizes similar mathematics that Anthea has spoken about. I'm also going to, for the first time in public space, I'm going to be talking about our Saffron BCI Flexible Fund, which is in the flexible category, a CISA category, and it's done particularly well. We launched it 3 years ago, and to date has attracted north of 700 million. So we're very happy with the performance of the fund, and we certainly are encouraged by the level of flows that we've been seeing into our flexible fund. You all know Saffron Wealth as a Stellenbosch Category 2A company. What's important, or what we consider it to be important about our business, is that we own and manage. Our interests are completely aligned with our investors. We eat what we hunt for our investors, and that's the niche that we enjoy operating in. We are technologically exceptionally innovative, and to any of our investors that have had a peek into our operations can attest to that. We love technology. We love utilizing technology to improve the speed, accuracy, and precision of our investments. So technology plays a big part of our business. Looking at the overall funds that we manage, you will know us for the BCI Opportunity Income Fund, the Saffron BCI Opportunity Income Fund. That's one of our flagship funds, and we run numerous segregated mandates on that. We've also got our active bond fund, which we think is an absolutely great bond fund. Obviously, we've got our Global Enhanced Income Fund, which is an Irish UCITS. So if you want dollar enhanced income, that's the place to put your money. And of course, we've got our Saffron BCI Flexible Fund in the higher risk quadrant. That's going to be the focus of my discussion today. Okay, so what is Portable Alpha? Well, Portable Alpha is an investment strategy that aims to generate uncorrelated excess returns above a benchmark. And a benchmark is typically something like an ALLB, an ALLZ, an MSCI World, an S&P 500. Those are what we consider benchmarks, and our goal is to outperform those benchmarks, or to generate an uncorrelated return over those benchmarks. The core principle is to maintain what we call market beta, which is just your market risk or your benchmark risk. And I mentioned such as the S&P 500. And then what we do is we layer on uncorrelated and stable return profiles onto that. And that's through the use of derivatives. And I'll go into that in a second. But really, the goal is to potentially outperform the benchmark without altering your, as the investor's, asset allocation. So in other words, you invest in our flexible fund. It has, and I'll get into this in more detail, it has an all-share index or total return index benchmark. But we are able then to add layers of return onto it without changing the asset allocation of your investment. Okay, so why do we also like the use of passive indexation being an active manager? Why is that? Because it enables us to focus on where we can add value, and it minimizes the cost on the areas where we don't believe we have a core competency. Saffron is not a equity stock selection house. We're a macro bonds house. So we focus on where we believe we can add value to your investments. And that is specifically by utilizing passive equity indexation. Again, the likes of the all-share S&P 500, MSCI World. Indexation allows for low-cost implementation. It means that it plays into our strength, which means that we don't have to select individual equity securities, so there's no security selection risk. It also auto-rebalances depending on the type of index or total return swap that we utilizes, which means it's very efficient from our point of view and therefore minimizes risk. And of course, reinvestment risk disappears. If you're using total return indices, it means you don't have the risk of dividend reinvestment. It means that it is a mathematically pure representation or exposure to what the market is doing on a total return basis. Okay, so let's quickly look at some of the costings. Let's call it the costing or cost efficiency of a portable alpha strategy. If we took the Johannesburg All-Share Total Return Index, it's going to cost me about 5 basis points before tax. Okay, so call it 6 basis points after tax. If I were to replicate, and we have run funds in the past where we replicated the all-share index with baskets of shares, and we invested 100 million, it would effectively cost us, after brokerage, JSE fees, security transfer taxes, it would effectively cost us 26 basis points. So before we even start, you are 26 basis points ahead, as opposed to costing 6 basis points versus 31, which is the all share. So giving you a net of 26 basis points ahead of the pack before the race has even begun. Looking at how do we stack this all up? How do we stack this all up to end up with a positive return over the all share or over your nominated index? We start off with a beta exposure in the form of using derivatives. And in this case, I'm utilizing very broad numbers for the purposes of communicating it effectively. So we would start off with 100% exposure to, say, the all share or the beta. Our financing cost indicatively around about now would be around 7.62%. The alpha we can easily generate through our fixed income strategies, and you will know Saffron as a fixed income house as well, with great performing funds, generating about 9.97% in our lower risk income funds. Transaction costs, let's round them up to about 10 basis points. That gives us, on an annualized basis, 102.25. So 2.25% per annum. Now compound that over 5 years, it becomes a real number. And that's what we're after. We're after trying to transport the power of compound interest onto the likes of risky indices, such as the all-share index. Let's get into a little bit about the fund right now. So the Saffron Flexible Fund, what's our investment philosophy? I've touched on it already. We believe that alpha and beta are distinct sources of total return. They can be managed independently. We like engineered solutions. And our outcome that we try and generate in our flexible fund is very much a structured or engineered outcome. And that we consider very appealing, specifically considering our skill set. The investment objective is to outperform the JSE Total Return Index with lower volatility and I'm going to explain to you the concept of enhanced capital yield, which is actually quite an interesting side effect of our strategy, and really serves to increase the attractiveness or the risk return profile of our fund. So how do we do it? Well, firstly, it's an engineered investment strategy. We maintain market exposure while seeking alpha sources, such as layering on fixed income alpha source, which is, of course, our skill set, and of course, passive equity index beta, such as a total return swap on the all share index. And by doing this, we can prove that we can optimize capital efficiency or your capital in our fund, and we can enhance your total return. So let's get into the actual numbers of how we do it. So why is Saffron one of the ideal houses to do this? Well, firstly, we've got a long-term track record of greater than 15 years in income and bond space. So both local income as well as hard currency income. We outperform the derivative financing cost on a very sustainable, consistent, and material basis. And alpha is also generated in our funds from duration, bank, and rated credit. So those are the different layers that we overlay onto the all share index to enhance that return and to get to that 2.5% that I mentioned in the previous cost breakdown. Okay, so this is also a great opportunity to market both our income funds and our equity fund, because the skill in our income fund is translated into our equity fund. So if we're looking at our active bond fund over 3 years, it's a nice number or term, 3 years. Our bond fund has generated STEFI or cash, and we can use STEFI as a proxy for the cost of our derivative exposure. Our bond fund over 3 years has outperformed STEFI by 6.77%. Which is very much as well aligned with what Anthea was saying in terms of nominal rates versus real rates as well. So there's a decent spread in government bonds there. Our opportunity income fund over 3 years has done 2.73% over the cost of finance. And STEFI being around about 7.8% over 3 years. If we look at our 5-year track record, so let's think about how sustainable is this strategy over the longer and long term. Over 5 years, we've achieved STEFI plus 6 in our bond fund, which is a high duration expression of our strategy. In our opportunity income fund, we've done 2.61% per annum against a STEFI of 6.34 and well ahead of the average in the income space. Over 10 years, and this is really, for me, this is the most important number, because if you're thinking equity exposure, you need to be thinking long term. So it's 5 years and greater. Over 10 years, our active bond fund has done STEFI plus 3.28%, and this is the most expensive fee class. So it's 100 basis points fees, and after those fees, we still make STEFI plus 3.28, and our income fund has done STEFI plus 2.45. So what I'm trying to demonstrate here is that there's more than adequate fat in our outperformance of our fixed income strategies to overlay onto an equity index and generate the kind of stable outperformance that I'm talking about. Okay, another interesting characteristic of our funds is because we're enhancing yield and transferring it into our equity fund, what does it do for the running yield of your equity fund or your equity exposure? If you think about the dividend yield of the all share index, it's just north of, say, 3.5. Or just south of 3.5. If you look at our fund, you can see that's the dotted line, the dotted red line. It comes in at 1.5%. But in fact, when you deaggregate it, because we're using derivatives and embedding the return, the income return into the fund, it raises our actual yield, annualized yield on the fund to north of 4%. So what are you getting? You're getting all share exposure plus an enhanced dividend yield or enhanced yield. And that's really the nitty gritty of what we're trying to achieve for our investors there. This is just, I know I'm also running out of time here. If we look at risk-adjusted returns over 1 year, the all share has had an absolute screamer. And at this point in time, our 1 year return is more or less in line with the all share index, but at a lower level of standard deviation. Over 3 years, also much in line with the all share index, but at a more material lower standard deviation of returns. In our flexible fund category, so this is the ASISA category, we've taken the top 20 funds and analyzed them in terms of ranking and returns over 3 years, which is a reasonable amount of time. And that's the amount of time that our fund has been running. Over 3 years, we ranked number 2, over 2 years, number 4, and over 1 year, number 2, with a dispersion factor of 8, which means that to what extent does our ranking change? That gives a factor of 8. The fund above us, who's first over 1 year, 6th over 2 years, and 53rd over 1 year, has a dispersion factor of 60. So if we look at our fund, and certainly the next fund in the list, ranked number 3, has a very similar dispersion factor, which we have to admire. So between fund number 2 and number 3, those are the 2 funds that I would recommend within a flexible fund category. And what it also shows is that the concept of portable alpha has a very real home in the context of equity investments. And that's us. Thank you.
Brandon, thank you very much. Very interesting indeed. I think it's going to be a lot of questions on a bit more of the mechanical workings of the fund. But let's stick to the fund and just trying to get my head around it. If you would want to bolt your fund into a client portfolio, and normally the starting point for a lot of investors would be, but what kind of asset class exposure do I get in the fund to try and assess, how this is going to impact my overall portfolio from a holistic point of view, from asset allocation. Just looking at a normal fund fact sheet of your flexible fund, it doesn't make a lot of sense at first glance because of the derivative overlays you use. So if I look at your equity exposure by way of example on the fact sheet, it says 88%, bonds and credit 33%, and then cash at the margin there's a negative. So maybe just for interest sake, trying to understand what asset allocation exposure I get or net equity exposure I get, what is that at the moment?
That's close on 90%. And that's why we're also quite happy with our overall performance, because we've achieved pretty much all share index performance with lower than all share index exposure. So, we absolutely can ramp that up to a full 100. We think that, we've been breaking new highs. We don't want to get off the wagon. We want to maintain that exposure as much as possible, but we certainly want to taper the potential downside of the fund. So hence we're sitting at around about that 90% overall exposure to the all share. And of course, what's been performing really well in our flexible fund is, of course, the outperformance of our fixed income components over the cost of financing. So very much like I think Anthea and I have been reading the same book recently, we're all a bit concerned about how stretched this rubber band is getting. And really the next stage of outperformance is going to be from protection, not from performance, in terms of differentiating performance from other asset managers. So really, I think it's going to be a test of how we protect capital over the next bit, rather than just heaping on or utilizing the maximum of your risk budgets.
And maybe just to reiterate again, the funds in the category SA multi-asset flex, so you've got a lot of flexibility. If I look at the typical SA multi-asset flex fund, they're a lot lower on SA equity at the moment. Some of them include global. You don't include global in your fund, if I've got it right.
That's an important
the equity
characteristic.
exposure, or the net equity you get is SA equity.
SA equity. Yeah, we're not an offshore equity fund, so you won't find the Magnificent Seven. It very much is structured around a Regulation 28 type investor, that's looking for domestic SA equity outperformance. That's our goal.
I know there's a lot of FOMO out there for clients or portfolios that were light in SA equity. SA equity obviously did phenomenal. It comes through in your fund performance very clearly. And again, maybe just to clarify, your net equity exposure that tracks the all share index, or you get the all share index exposure. So it's not cap
Correct.
swix or anything
Correct.
like that. So would it be fair to say that with a high level of net equity exposure and for your beta component, you're tracking the all share, that you're actually capturing some of that market momentum?
Absolutely. Absolutely. And hence our 90% exposure is a testimony to, firstly, the strength of the index as a beta building block. And the 90% also demonstrates that, we don't have to go, foot to the floor in terms of risk budget utilization in order to get close to or beating the all share index. So there's a degree of conservatism built into the index as well, into our positioning as well.
I'm gonna, not that you look at or focus on macros. You did mention, this is a long-term investment strategy, but I can't ignore this. And I mean, there are some nerves in the market. There are some red flags, especially if you look at towards the US. We know if the US sneeze, everybody catches a cold. And in the same breath, yes, we know that SA equity is still very attractively priced, and whilst the dollar remains under pressure, and it doesn't come in a straight line, can't tell you, nobody can tell you where it's going to be in 6 months or a month or 12 months from now. But emerging market equities and SA equity tends to do well, but there's always nerves around equity markets, especially through December. If you look historically, just your views, macro, very briefly.
Very
Is
briefly.
this the time to take profit? Obviously not on your fund, because your net equity is very high. And if you do take profit, how do you do it in a fund, in a flexible fund?
Yeah, in a flexible fund, there's obviously a couple of levers one can pull. The first is an effective reduction in the exposure to the all share index. Now, typically that would be one of our latter type activities that we would enter into in the late part of the cycle. Right now, there's very good reasoning to be thought around parameterizing your risk, starting to buy puts. Volatility is very low right now, which means the cost of protection is actually relatively quite cheap. So now is not a bad time to just start overlaying some levels or layering of protection. The second important thing is on the fixed income side, which has also contributed very materially to our fund performance, is to start using the likes of interest rate swaps. So start just trimming the exposure from a swap point of view, maintaining your margin, because remember, the key behind the performance of our fund is not level, it's margin. It's about capturing the gap between things. So trying to secure that margin as much as possible. I think also bearing in mind that the all share index has done exceptionally well on the resource side, but it's coupled with a very strong rand. So it's not like the total return hasn't had its own currency headwinds. Typically the outperforming components of our all share have also been offshore counters, listed domestically, but really having offshore exposure, the likes of the 10 cents and those counters with foreign or hard currency denominated returns. So to some extent, there's already an automatic shock absorber built into our all share via the currency.
On the rand hedges, for
rand.
lack of better words,
Exactly
that. So you get that exposure. And interesting enough, if I just look at the month of October, the small mid caps actually really came through hard and fast. But again, if you look at the market beta being the all share, and that's why I mentioned the fact that you do capture market momentum, the re-rating automatically takes place in the fund. Brandon, I think there's a lot more technical questions or technicalities that can be unpacked in the fund, but I think you're a really good option for clients that wants to get a bit more exposure to SA equity, but in an engineered fund where there is portable alpha and where it is managed, that composition. I'm going to pause there for now, Brandon. Anthea, I didn't forget about you. You're sitting patiently waiting for us all. I'm very sorry about that. Maybe just again, and I know we are semi-familiar with your money market fund. You did present on the actual fund before, but let's just talk about SA bonds quickly. Because that is, you've got some exposure in your fund. You explained so very nicely how bonds work. And it's a good refresher to understand where those returns are coming from. But on SA bonds in particular, and in your topic as well, you mentioned, SA bonds are 21% over the past 12 months to end of October, which is phenomenal. A lot of clients are asking, but how much of the potential rate cuts, or maybe too many rate cuts, are in the market or in the bond prices? We've had super returns, but is the party not at end?
Difficult to say, Eugene. I don't think we've had too many rate cuts. So let's just talk about South Africa for a moment. And I know that the Reserve Bank, their mandate is inflation, financial market stability, and actually they have a secondary mandate, which is growth. And in South Africa, we need growth. So that's kind of, I guess, where we are, despite having a very hawkish Reserve Bank governor. So I don't think we've had enough rate cuts, or too many. I shouldn't say I don't think we've had too many rate cuts. I do want to see inflation come down. And from that perspective, when we think about the fund, so we can see that the FRA curve is pricing in another rate cut, and potentially even a November rate cut now. From that perspective, when we're managing the fund, or when we're thinking about managing the fund, if we think we're still in a rate cutting cycle, then the tools we have in the money market fund are very simple, actually. We decide whether we want fixed or floating rate notes. And earlier on in the year, when we realized we were in this, or last year already, we realized we were in this rate cutting cycle, we bought fixed rate notes. So obviously, as your fund performs, let's say, at 10%, that's where you've bought the yield or the bonds. As rates get cut, that difference expands. And so we're quite happy kind of where we are positioned at the moment. We are having lots of conversations in our team at the moment. If they're going to change the inflation target, where do we go from here? We're of the impression that real rates are still good, and that we still are in an environment where there is still space for the Reserve Bank to continue cutting rates in South Africa.
I tend to agree with you. And just looking at money market funds, and your funds in particular, I mean, it doesn't matter which term I look at, you're always ahead of Steffi, so you deliver on the goods. It comes through in your fund. But maybe just give us a sense briefly of what the yield is in the fund, or on the fund at the moment.
So today, the current running yield on the money market fund is 7.56. Now, this changes, of course, depending on where we trade and what we trade. And I'm very proud to say that this is a consistently top quartile fund. Every once in a while, maybe every 8 months or so, we might fall down to the second quartile. And this is generally when we are repositioning the fund, or kind of changing what our investment thesis on where the market is, or how we want to position the fund. The interest plus fund today is currently at 8.17%. And again, it's a longer duration fund. So we can take a weighted average maturity, or we can take bonds up to 3 years, whereas in the money market, your maturities restricted to 13 months. And there we can use more instruments like I've shown you to either generate alpha or above benchmark returns, or to protect against the downside in this interest plus fund, which is, I guess, pretty much the equivalent of like a flexible income fund in fixed income, if you want to look at it that way.
Absolutely. And I mean, if you look at the money market, I mean, every client needs a money market fund in their portfolio somewhere along the line, and you are looking for the funds that it's got really good, consistent returns. But I think, as you mentioned, extremely important is that risk management or mitigation of risk, and that's where a lot of focus are within your team, and it seems to be working very well. For last question, Brandon, I just want to test your views, because fixed income, as you mentioned a few times, in the flexible fund, very big part of that. Your views on SA fixed income at the moment, and that fixed income component currently, where are you? Is it leaning more to fixed rate or floating rate notes?
Well, I think, in previous discussions we've had on Boutiques on Wednesday as well, we were talking about having a preference for the 2035, 2030, 2040
Yes.
area. And that's actually done exceptionally well. We still think there's a few legs in it, by that I mean we don't want to be swimming against the current just yet. So we don't want to be contrarian just yet. We think that the market can still deliver. There's an exceptionally attractive running yield embedded in the ALLB. I think our bond fund running yield is around about 10%, thereabouts. So a very, very attractive running yield, but it does come with risk, being a bond fund. I think from a macro perspective, we still are tied at the hip to a degree to the treasury curve. So the extent to which the global rates subside or lower creates space for our central bank to lower rates. If against the US in particular, our 10-year nominal bond versus US nominal bond is almost at all-time lows again. So that means that in relative space, South Africa is not as great value as it has been in the past. To just call it like it is. There's still value. It's not as great value. What will improve its value will be if the US curve can come lower. From a macro perspective, we are getting very, very close to points where, not in this fund, but in other funds, we will likely be starting to accumulate dollars. So that's going to be an interesting, it's probably the single biggest call we all have to make in the future is a currency call.
I'll park that for next discussion, because I think we can spend a lot of time on that. But I tend to agree with you. Anthea, Brandon, thank you so much for joining us this morning. It's been extremely interesting, and to share your views. Both funds, although a money market fund, there's far more to it than what meets the eye. And Brandon, your flexible fund, obviously something very different to what we're used to. If you're looking for that portable alpha, definitely a consideration for client portfolios. Thank you so much for your time this morning. We look forward in you joining us for future discussions. But for now, we are going to pause it there. And thank you again for your time.
Yes. Thank you, Eugene.
Thanks,
Thank you,
guys.
Anthea. Cheers.
To our audience, quick reminder, next week, Wednesday, we're continuing our discussions. We've got All-Weather Capital and ID Capital Partners. Looking forward to seeing you all again next week, Wednesday. Have a super week further and be safe.